any hopes that the coming recession, and we're getting confirmation of this. I mean, you just pick up the vibes from central bankers. They are worried about the current situation. They're talking about a monetary reset. I mean, all these things are signs, if you like, of concern at the very, very top of our monetary planning system. And consequently, I think there's little doubt that we are heading for this recession. But if you take the combination of trade tariffs and at the same time the top of the credit cycle, you're back to where we were in 1929. And in 1929, I'll remind your viewers, the Wall Street fell until 1932. It lost 90% of its value top to bottom. We are in exactly the same position now. The evidence has been suppressed. If you just look at the difference between what the CPI says, inflation 1.5%, 2%, whatever it might be, it bears no relation at all to what John Williams at Shadow Stats is saying, or indeed the Chapwood Index. I mean, they're saying it's closer to 10%. So, you don't believe the government statistics, but what you've got to do is understand that the next round of monetary inflation is going to be considerably larger than the last one. The risk that it will knock out the purchasing power of your fiat currency is therefore very, very real. So secure some sound money, and sound money is basically gold, silver, or maybe a good cryptocurrency like Bitcoin would give you some protection. The hedge funds and all the rest of it do not have this long exposure to gold. They have yet to get into it. Now, assuming that this 100,000 contract position does not get spooked out of the market, and believe you me, you don't take a 10 million ounce long position in the futures as a flaky trader. You do this because you know there's something going to happen. So, it's a pretty good indication that this is important money, if you like, in terms of an indicator. As that begins to realize, you'll find that the speculators, the hedge funds, are going to start buying into it.
Welcome back to Finance and Liberty and Reluctant Preppers. We have a returning guest who's always popular with our viewers. Alasdair Macleod is the head of research at GoldMoney.com. Alasdair joins us from the UK, where he is based, and today is Wednesday, December 4th, 2019. Alasdair, thanks for joining us here again on Finance and Liberty.
Thank you for asking me, DK.
We've had you on several times, and you've talked to us on a recurring theme that has been increasing in the amount of data that's been available to corroborate your claim, and that is that we are late in a credit cycle, a credit expansion, and that in the past that has led to things quite dramatically different from what we're currently experiencing. Can you talk to us about some of the main sources of evidence in terms of charts and data and facts and figures and evidence in the actual economic activity that can really help us stay grounded in the reality of what we're heading into and not be subject to sort of the propagandistic messages we're being fed by the mainstream media or by government leaders telling us that happy days are here again and it's all roses for going forward?
Well, I would preface any remark I make with a quote from Lord Canning, who was Prime Minister, I think it was in 1819, round about then, so a long time, 200 years ago. And he said, statistics will tell you anything but the truth. So relying on statistics is not a very clever idea, and this is why people so often get caught out. So you really have to feel your way, I think, through what's going on, and you've got to understand certain things. And one of the most important things to understand is that we are driven by a cycle of expansion and contraction of credit. Now, the expansion takes some time, and this is something that the states force on us through their system. I mean, particularly banks. Banks are licensed to print credit out of thin air, which is all part of that increase in the supply of money. And the increase in the supply of money is recorded in gross domestic product. If that goes up, then it's good. But actually, all GDP is telling you is that there is more money being pushed into the economy. It doesn't tell you what that money does. So we have a situation really where the statistics are actually even misleading the people who are trying to manage things for our government.
So let me just ask you, I've got to get clarity on this because I've been another one who's maybe been a misconception all along that GDP I thought was a measure of like economic productivity or economic activity or production or something like that, not just the money supply.
No, it's not. I mean, the way to look at it is quite simple. If you start with the base amount of money in the economy and you don't increase that quantity at all, then by definition, GDP can't increase. Because what is GDP? It's a record of all the monetary transactions between time A and time B. So the only way you're going to increase the monetary value of those, or the record, if you like, of those transactions is either to include new things in it, like, which the EU has done. They've even tried to include things like prostitution to sort of bolster up the numbers. Take cash transactions out of the economy and put them into the banking system. That bolsters the numbers. Why? It just records, the value of transactions. Now, if you, let's say, increase the quantity of money by 10% between time A and time B, and the bulk of that goes into transactions, then transactions will rise 10%. It's quite simple. It's got nothing to do with what you actually buy, what you actually choose over what you don't choose. It does not record economic progress or productivity in any way whatsoever. All it records is simply a money total. And if you understand that, then you're a long way to understand why the statistics that governments produce are completely irrelevant to deciding outcomes.
All right, I interrupted you, and you were on your way to laying a groundwork for my first question, which is, what are the signs and evidence that we are currently entering a late credit cycle? Okay,
so the first thing to understand is that banks increase the amount of credit when they start off. If you start from a point where expectations are pretty low, banks will be very cautious. Gradually, what happens is that things begin to sort of stabilize. And when the banks get the drift of that, then they will start lending to the large corporations who they feel safe lending to. And then gradually over time, they will start lending to the medium-sized businesses. And then they will say, when you know that it's come to an end, you find the bank knocks on the door and says, do you want some credit? We can offer you an unsecured line of $5,000, $10,000, whatever it is.
So down the food chain of risk, down to get people who really shouldn't be taking on risk, that sort of thing.
Yeah. And then what happens is that, banks start getting hungry for business. So what they do is they start competing. So if, let us say, the normal rate of interest to lend to a business is 5%, Bank A will lend at 5%, but Bank B comes knocking on the door and says, we can do a slightly better deal. We can lend to you at 4.5%. Why don't you move your account to us? And you get that sort of behavior developing. You know that it's getting towards the end game. And what happens is that instead of things sort of gradually declining, it's because it's driven by banking emotion and also fueled by central bankers who give the whole thing an extra kickstart by increasing the quantity of base money. Supposedly trying to, sort of manage the quantity of money in order to maximize employment without setting inflation above, say, a 2% target, which is all a load of rubbish, basically. But you come back to the basic thing that banks suddenly find that they've got themselves overextended. Because remember, if you're a bank, you make a lot of money basically by gearing up your balance sheet, say, 10, 15 times. In other words, what I mean is that you've got a base capital, let's say, of $100, and you're lending out $1,000. A 1% increase in profits on those $1,000 comes back as a 10% increase in your base capital. Lovely stuff. But when it goes wrong, my goodness, it goes the other way very rapidly. So you can understand that as soon as the bankers begin to detect that there's something going very wrong, in the economy, whether it's domestic economy, global economy, whatever, then they begin to draw in their horns very quickly, and they all do it at the same time. And that is why when you get the contraction of credit, you usually get a banking crisis and call it a systemic and banking crisis at the same time. So that is still just ahead of us. Where we are now, if you look at the psychology of the banking system, they are teetering on the edge of a chasm. And getting sort of a bit nervous about the outlook. We all know that the world is heading towards some sort of recession. We hope that the central banks will stop it by reducing interest rates, doing more QE, whatever it is. We already see the Fed being forced to do this because of problems in the repo market. But basically, we assume until we know otherwise that the central banks will throw money at the problem and rescue us from a potential recession.
Yeah, and I have to say that you made the generous statement that we feel that we're on the verge of a recession, but goodness knows there are several loud voices out there saying, no, we are in the middle of the longest expansion ever, but things are let's start the second half of it now. Here's another 18 years coming up, and we're going to go to Dow 36,000 and on we go. So help us to see the way that you see why you believe, in fact, there's evidence that demonstrates we are, in fact, near the late stage of an expansion rather than kind of taking a little pause mid-expansion and off to the races we go again. Why do you see signs of near exhaustion?
Okay, right. Well, sometimes there is no obvious trigger. It's just a loss of momentum, if you like, in the whole situation of the credit creation and the false impression it gives of economic strength, recovery, progress. You use the term progress. No, you didn't quite, but almost. Do you see what I mean? You sort of think, hold on, things are going to slowing down. Other times, we're lucky enough to actually get a very clear signal. To my mind, the clear signal we have this time is the trade wars that exist between the two major economies in the world, America and China. This is something which is born out of American trade policy. They are trying to contain imports from China by effectively raising the price of imports from China by imposing tariffs on top. And they hope that way they'll sort of shift demand from Chinese imports to American domestically produced goods and services and so on and so forth. But the effect of it has actually been to almost stop, in fact, it has stopped global expansion of trade. And you see this in things like shipping rates, for example. The Baltic Dry Index has sort of just gone down, collapsed. Transport rates across sort of major continents like the Eurasian continent, those costs have come down. So you can see that, the reason the costs have come down is because there's nothing to ship. There's not so much to shift. And then the other thing you see is the German economy. This is a sort of secondary effect from the China-United States trade war. The German economy, their largest customer is China. They buy all the Mercedes and BMWs and other things because the Germans make things extremely well. Demand from China has slowed down. Germany is now tipping into a slump, if you like. And this is the best economy in the European Union. The rest of it has never even got off its knees. You look at the Italians and the Greeks and the Spanish and the French. What goes on there? Absolutely nothing, because you've got corruption, you've got governments which are bust, any number of reasons. But Germany is the sheet anchor for the European Union. It's heading into a slump. Why is it heading into a slump? It's heading into a slump because China's demand has collapsed, and that has knock-on effects the whole way through the German economy. And we're going to be seeing the same thing happening in America. You can chart the events. So it is quite clear. And I would also add that any hopes that the coming recession, and we're getting confirmation of this. You just pick up the vibes from central bankers. They are worried about the current situation. They're talking about a monetary reset. All these things are signs, if you like, of concern at the very, very top of our monetary planning system. And consequently, I think there's little doubt that we are heading for this recession. But if you take the combination of trade tariffs, and at the same time, the top of the credit cycle, you're back to where we were in 1929. And in 1929, I'll remind your viewers, the Wall Street fell until 1932. It lost 89, 90% of its value top to bottom. We are in exactly the same position now. There is a difference, however. In those days, you had gold convertibility, so prices were in effect in gold. This time, there's no gold convertibility. Prices are in fiat currency. So the objective, I guess, of a central bank will be to expand the quantity of fiat currency so that the prices of assets do not fall in the way they did in 1929. So you've got you've got a lot of potential for currency expansion of the amount of money in circulation, which they'll do through QE, because another side of the recession or a slump is budget deficits start increasing very rapidly. Now, in America, your starting point from the current year, according to the CBO, is $1 trillion. And so I don't know what it'll end up at, 1.3, 1.4 trillion. And the foreigners have stopped buying the dollar. We know that from, if you look at the Treasury tick figures, you can see that demand is sort of hovering along but not growing. And if you see, as I do, the credit cycle turning, there may be some people, foreigners, caught without dollars. But I can tell you that if you just look at the tick figures, far more dollars are owned than Americans own foreign currencies. It's almost 2 to 1. Total value of all assets held in foreigners, and this is recorded, these figures are somewhat out of date, but you're looking at a combination of about 19 trillion and cash and CDs and short-term things, instruments like that, a further 4.3 trillion. Those are the last figures we have, giving you 23.4 trillion. Now, that includes foreigners' investments in things like property in the United States, ownership of corporate subsidiaries and things like that. But it does also include a pretty large slug of US treasuries. And if you look at the figures and the flows, it's quite clear that over time, the only net buyers of any significance in the US Treasury market are foreigners. So what happens if they stop buying? Where are you going to fund these US Treasuries? I mean, do your Keynesians in the US Treasury and at the Fed actually want to encourage savers to provide shortfall? But they then say, hold on, we've got a problem there, because if savers start saving, it's going to eat into consumption. So, this is not good. So you can see everything is lining up for a massive, massive crisis. If you can see it now, there's no point in hanging around and sort of thinking, well, we'll just watch how developments occur and all the rest of it, because this is something that could well accelerate overnight. And we've got I mentioned earlier the repo market.
Yeah, so I was going to ask you about, speaking of overnight, could you take us into what happened back in late summer that suddenly where the overnight rate went from 2% to 10%?
Right. Well, the first thing that your viewers should be aware of is that the last time we had an explosion of outstanding repos from the Fed was in 2008. Now, hold on a minute. 2008, when was that? Top of the last cycle, wasn't it? And as it crashed. This time, we have got actually a somewhat larger increase in outstanding repos. This is between the Fed. We don't know what the repos are sort of between the commercial banks, but this is recorded on the Fed's balance sheet, if you like. Now, the reason this started, it's interesting. We don't know the reason really, but I can tell you that there was a coincidence, because the day in which the repo rate suddenly shot up to 10% overnight was the day in which Deutsche Bank completed its sale of its US money business, as it were, to BNP, its prime dealership to BNP. That day it happened. Now, you can see that some of the hedge funds, perhaps, the large depositors who were dealing with Deutsche Bank's prime dealership had balances on Deutsche Bank's balance sheet, if you like, in the form of collateral, whatever. And when it moved, that money moved out. Did Deutsche Bank have a replacement? I don't know. It could be they didn't go to BNP and went to somewhere safe like JP Morgan. Or safer, I should say, like JP Morgan, in which case BNP's got the problem. We don't know. But what we do know is that there's a foul up in the repo market, which is ongoing. And we also know the last time this happened was 2008. So, we're getting sort of certain amount of tangible evidence that we're on the edge of a chasm of some sort. Potentially. We might not fall off it, into it, as it were, fall off the edge into the chasm. But history tells us we will.
One thing I didn't hear you mention, but it was brought up by our recent guest, Danielle DiMartino Booth, former member of the advisor to the Federal Reserve Bank in Dallas, Texas, was that the bond curve inversion that happened earlier this year and was denied by the officialdom and yet was borne out by further evidence and research that had happened over actually a period of months, has been a very reliable indicator in the past of being near the beginning of a major recession. Can you talk to us about what you think the truth is about what actually did happen in the bond yield curve inversion, what that actually means, and why people should care about it?
Well, it clearly did invert, and whatever anyone says, it did invert. The problem can come from either of two sources. Firstly, that long-term borrowers are withdrawing from the market. They say, there's too much risk, if you like. We see too much risk in the future, therefore we're not going to borrow.
When you say withdrawing, you don't mean withdrawing cash. You mean withdrawing from borrowing.
Withdrawing from borrowing.
Withholding
yes,
from
sorry.
borrowing. Okay,
withdrawing from in other words, there is no demand, if you like, for savings of a maturity, let's say of 10, 15 years, whatever it is. And of course, you've still got the pension funds and the insurance companies who traditionally look to that sort of lending as part of their overall risk profile. So that's one way that it happens. The other way that it happens is that the Fed might have just set rates at the short end just a bit too high for the current conditions. So what I would say about an inverted yield curve is that under normal circumstances, it's a very reliable signal that things are not going quite right. But there can be exceptions. And so I wouldn't just take the yield curve itself as absolutely clear evidence that the world is going to hell in a handcart. But what I would do is I would take it very seriously, and I would then look for other evidence to see whether the evidence is there to support it.
Okay, so you've talked to us about maybe half a dozen or 10 different kinds of perspectives of looking at the activity, economic activity, financial policy, and how it's playing out, comparing it to the past and saying, all of these tea leaves seem to be saying the same thing. Do you see any compelling evidence on the other side of the discussion? Let's just put on the contrarian hat for the moment and say, no, what is there any validity in any of the evidence that anyone points to that talks about we're just taking a little breather in the middle of a huge expansion, here we go again?
Well, my problem with that is that if you understand that there is a cycle of credit and it's that drives everything, then it makes it very, very difficult to see anything positive in the current situation, when the current cycle, by any definition, has run at least its course. So I hear the question you're asking, could it be that a bit of stimulus from the central banks? I mean, we're seeing the ECB, sort of getting, if you like, its asset purchase program, which is QE, going again. You can see that you have an asset purchase program by default through the expansion of the repo market.
No, that's not quantitative easing.
No, but I know, but one way and another, you can see money being pushed into the system. Now, the hope would be that it stabilizes the system and suddenly we're sort of recovering and we live happily ever after. I see no sign of that at all.
Or at least for a while, yeah.
At least for a while, yes. And if so, how long? I mean, I just don't see that works. I mean, they've done it time and time again. And the problem is that every time you try and do this, it has less credibility. I mean, if you think back to when Greenspan did it in 2002, 2003, I think we were all horrified at the time at the way in which he cut interest rates to, I think it was 1.25%, might have been 1%, something like that, to kickstart the whole thing. And he was recorded in an interview saying, we've got to get asset prices rising. So, that was, if you like, the inflation mantra at that time. And then the whole thing falls apart because the asset prices, particularly in the form of residential property, just got completely out of control. And we all thought life was wonderful. We all thought that this could go on forever. I mean, I remember seeing banks financing off balance sheet. What they were doing is they were getting securities listed on places like the Channel Islands Stock Exchange, $1 trillion or 1 trillion euros of authorized issuance, and they would start maybe with 100 million or something. But these were huge numbers, which they would use for securitizations. And these were European banks in the main doing this. And of course, when the music stopped, guess what? Various German banks effectively had to be rescued and merged and all the rest of it, like Bayerische Landesbank, I seem to recall. I can't remember all the names at the time, but, it was worse then than it was in Greenspan's time. And now we're approaching a point where the amount of debt has increased 40% since the Lehman crisis. There is so much more money around. We routinely talk in trillions, no longer billions. And we think there's nothing wrong. We think we can just sort of give it another kick in the stimulus and off we go again. I'm sorry, but this is not realistic. We are in a very dangerous situation.
All right, so we've talked up till now about this macro financial edifice. Can we just bring it now down? And you did along the way talk about how that becomes, how it comes home and personal to individual banks who are looking at and pension funds who are looking at how are they going to solve their problem, their risk problem, and their yield problem when they're looking at this developing situation. So let's take it down to the individual person and the individual family, and they're trying to solve their risk problem and their yield problem. What are some considerations? We're not here to give direct individual financial advice, but what are some considerations that the individual earner, saver, investor, family, head of family need to keep in mind to make sure that they're taking care of business for their family at this climate that we're in?
I think there are two recommendations I would think that people should consider. The first is secure some of your capital into sound money, because inevitably the consequence of massive monetary inflation is it will undermine the purchasing power of a fiat currency. Now, this has happened since the Lehman crisis, but the evidence has been suppressed. If you just look at the difference between what the CPI says, inflation 1.5%, 2%, whatever it might be, it bears no relation at all to what John Williams at Shadow Stats is saying, or indeed the Chapwood Index. I mean, they're saying it's closer to 10%. So, you don't believe the government statistics, but what you've got to do is understand that the next round of monetary inflation is going to be considerably larger than the last one. The risk that it will knock out the purchasing power of your fiat currency is therefore very, very real. So secure some sound money, and sound money is basically gold, silver, or maybe a good cryptocurrency like Bitcoin would give you some protection. So you've got to look at those alternatives. The other thing I would say is that you must have sufficient income to pay your interest obligations and remove the possibility that someone's going to foreclose on you. Now, in many cases, the banks are going to foreclose on people anyway. I mean, where you have unsecured loans, for example, they will foreclose. But if you've got a mortgage on a house, you're probably okay so long as you can continue to service the mortgage. And the reason I say that is that it's not just you, but it's everybody else in the same boat. So when the odeur hits the fan, the answer basically is that everybody in the same boat, they will be rescued. It's the people who are not in that lifeboat, if you like, who have extensive personal borrowings with no security, whatever. Those are the ones at risk. So position yourself, if you like, to be with the masses on the things that matter, like a mortgage. Make sure that you can service these debts and have some sound money. Have some sound money on the side, as it were, so that you've at least got some money if the fiat currency fails.
This is serious business. We've been sharing this kind of message for actually several years, and have been criticized roundly for being tone deaf to the expansion, having missed out on the party, having been beating the warning drums at a time when all things were green and go. At some point, they say, well, even a stopwatch is right twice a day or something like that. But it sounds like there's a lot more to see now than we saw before in terms of things playing out in real evidence that this is the true environment that we're heading into, and that people would do well to be very watchful, as the banks are giving evidence that they're being watchful, and even foreign lack of purchasing of U.S. Treasury debt, et cetera. Just that there's the big players with the big money are exercising extreme caution. Now, you wrote just recently about a few months back about a silver whale, but now we're talking about a gold whale?
Yes. It's interesting because we have seen the open interest on COMEX increase and increase and increase. And for the first time ever, it went over 700,000 contracts. I'm talking about the gold contract. COMEX is just actually part of the paper system. There is equally, and probably somewhat larger, the London Bullion Market Association, which is a forward market as opposed to a futures market. I won't go into the differences, but basically you've got a bullion bank will have positions in both markets. So while it might have a position in COMEX, we don't know what's going on in an equally large market and probably larger market somewhere else. So we've only got partial evidence. But when you see outstanding contracts go over 700,000 for the first time, the previous high being something, I think, like 690 very briefly, but a more normal level being, say, 450 to 550,000 contracts, 700,000. This is an enormous position. And it tells us that you have got a lot of speculative money buying into the idea the gold price is going to go up. And so when you see open interest go up to a high level like that, you know that there are a lot of speculators in there who tend, on the margin, to be pretty flaky. In other words, if they see something which changes their view, they're very quickly out, and they act almost as a herd, and so they drive the price down. The other side of this is the bullion banks are short to the speculators, and basically they have it in their interest to try and bang the price if they detect any wobbles amongst the speculators. Now, we haven't really seen that because even though the price has drifted lower, open interest has not come off. And then last week, I think it was last Tuesday, we saw, so it's a week ago today, we saw a rollover from the expiring December contract into the February contract, which is the next contract, of about 107,000 contracts. This is unprecedented. Now, it happened in the week of Thanksgiving and all this sort of stuff, so there are distortions, yeah. But taking all that into account, there is one player there. It looks like there's one player with something like 10 million ounces of gold in a contract, which is 311 tons of gold in a long position, who is adamant that he's going to stay long. He rolled it forward. He was not going to sell down. Now, this is interesting because if you put him to one side and you look at the other speculative positions, they're not as extreme as the headline number would suggest. They are actually, on last Tuesday's commitment of traders figures, just marginally oversold. And by marginally oversold, I mean slightly less than average exposure, long exposure. So what that means is that going from here, it's quite possible that because the hedge funds and all the rest of it do not have this long exposure to gold, they have yet to get into it. Now, assuming that this 100,000 contract position does not get spooked out of the market, and believe you me, you don't take a 10 million ounce long position in the futures as a flaky trader. You do this because you know there's something going to happen. So, it's a pretty good indication that this is important money, if you like, in terms of an indicator. As that begins to realize, you'll find that the speculators, the hedge funds, are going to start buying into it. You will see that open interest go up to over 750,000 contracts. Now, on the one hand, you say, my goodness, this is so overbought. This is incredible. But don't forget, 100,000 of those is probably one position. But also, it puts huge position on the bullion banks because they are short. They will be short of huge quantities of futures, which they have never, ever seen before, not at this level. We don't know what they're doing on the LBMA. The chances are they're probably net short there as well, if anything, to customers on unallocated gold accounts, if not actually in the market itself. So you can see that things are lining up to be very interesting for the first quarter of next year. And if on top of that, I remind you that from 2015 onwards, every December has been a good month. And it comes after the expiry of that December contract, which is right at the beginning of the month. So we are likely to see this market. There's a very good chance it will run away. So that was the basis of my tweet.
Interesting. So we're seeing repeating evidence of the aging end of a traditional credit cycle by the behavior from many different directions, governments, banks, etc. We're seeing loss of confidence in people wanting to take on new U.S. sovereign debt. We're seeing weakening of the strength of the remaining strong economy, the German economy, in the Eurozone. We're seeing inversion of the yield curve, which has been a past predictor of recession, and we're seeing evidence through the repo market of bond illiquidity in their ability to lend to each other, and we're seeing the evidence of perhaps major players taking unprecedented positions long gold. It truly will be interesting times in the next quarter or two as this plays out, and we're just glad to have you here, kind of giving us your perspective on things that truly most people hear wisps of factoids about, but when you put it all together for us, it really helps us to see things in a much clearer way. And Alasdair, we're grateful for your presence here, and just wondering where people can follow you more closely if they want to keep on an ear to your insights going forward.
Well, I write a weekly article for GoldMoney. So if you go to goldmoney.com, and under research is insights, and that's where they're posted. And they're posted on sort of around about midday to early afternoon Eastern Standard Time. And I do a market report weekly as well. That is the following day on Friday, and that's under something that equates to market reports. I can't remember the exact phraseology. But if you go onto the research tab, you'll find everything you need. I hope your viewers will avail themselves of the opportunity.
Very well. Thank you, Alasdair, for joining us this time again here on Finance and Liberty and Reluctant Preppers.
That's very much my pleasure, DK.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your gold and silver and support this channel at goldsilver.com/?AFF=RP. Hey Reluctant Preppers, if you want to hear more bonus footage from other guests we've had on, come on over right now to patreon.com/ReluctantPreppers and access that bonus footage there. Take care. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.